You're watching something that hasn't happened in financial markets for over a decade, and most people have no idea what it means. Silver just crossed $109 per ounce as of January 26th, breaking through the $100 barrier for the first time in history, just 3 days earlier. But that's not the story. The story is that after being locked out of precious metals for decades, the world's pension funds managing nearly $70 trillion in assets just got official permission to buy silver, and they're starting to move. This isn't retail investors chasing a hot tip on Reddit. This is institutional money, the kind that moves in billion-dollar blocks and changes markets permanently. And they're coming for an asset where the entire global annual supply is worth less than what some of these funds manage in a single day. Let me put this in perspective for you. When India's pension regulator announced in December that the country's $177 billion national pension system could now invest in silver ETFs, that wasn't just a policy change in one country. That was the first domino in a legitimacy cascade that's been building since July of last year, when Basel III banking regulations officially recognized physical gold and silver as Tier 1 assets with 0% risk weighting. What that means in plain English is that the global financial system just declared silver to be as safe as cash and government bonds for the first time in modern history. And when you combine that regulatory blessing with the supply, the crisis we've been tracking, with industrial demand that won't quit, and with price momentum that's already carried silver up over 250% in the last 18 months, you get the setup for $200 silver, not as a prediction, but as a mathematical inevitability. Now I know some of you are thinking this sounds too good to be true, that you've heard big calls before and watched them fall apart. So let me take you back to 2011, because that year taught the institutional investment world a lesson they've never forgotten. And it's the reason why what's happening right now is completely different from every other silver rally you've ever seen. Back in April of 2011, silver hit $49 per ounce in a spectacular run that had everyone convinced it was going to $100. Retail investors were piling in, silver coins were flying off dealer shelves, and the internet was full of people calling for 3-digit silver by year-end. Then reality hit. Within 6 weeks, silver crashed from $49 to $28, wiping out 40% of its value and leaving a trail of destroyed portfolios and margin calls. The people who got hurt worse were the ones who bought at the top with leverage, who were chasing momentum without understanding the fundamentals, who thought a parabolic chart guaranteed future gains. But here's what most people don't know about that crash. While retail investors were getting destroyed, institutional money managers were taking notes. Pension fund managers, sovereign wealth professionals, and asset allocators at major firms were watching that entire cycle and asking themselves, why silver behaved that way? What went wrong? And most importantly, what conditions would need to exist before they could justify putting retiree money into the metal? And the answer they came up with was this. They needed regulatory clarity that silver wasn't just a speculative commodity. They needed structural supply deficits instead of surplus inventory. They needed industrial demand that was growing, not shrinking. And they needed price discovery happening in physical markets, not just paper derivatives. For 13 years, those conditions didn't exist. Silver bounced around between $15 and $30. The regulatory environment stayed hostile to alternative assets and pension portfolios, and the smart institutional money stayed on the sidelines, waiting for their checklist to get satisfied. But something changed in 2025. And it changed fast. In July of 2025, Basel III implementation hit a critical milestone. The new banking regulations that had been phased in over several years finally reached the point where physical gold and silver held on an allocated basis got classified as zero-risk, Tier 1 capital. Let me explain why that matters, because this is the foundation of everything else. Under the old rules, if a bank wanted to hold gold or silver, it counted as a risky asset requiring capital reserves. That meant holding precious metals was expensive from a regulatory perspective, which meant banks didn't want to do it, which meant they discouraged their wealth management arms from offering it, which meant pension funds and institutional investors had a hard time accessing it even if they wanted to. Basel III flipped that equation. Now physical metal, as long as it's allocated, meaning you actually own specific bars with serial numbers, not just a claim on a pool, counts the same as holding cash. Banks can hold it without tying up capital, which means they can offer it to institutional clients, which means pension funds can access it, which means the dam that's been holding back $70 trillion just cracked open. 5 months later in December, India made the move that proved this wasn't theoretical anymore. The Pension Fund Regulatory and Development Authority announced that the National Pension System, which manages $177 billion for Indian workers, could now invest up to 5% of assets in precious metals ETFs, including both gold and silver. Now 5% might not sound like much, but do the math. 5% of $177 billion is $8.85 billion. The entire global silver market mines about 850 million ounces per year, which at current prices of around $109 is worth roughly $92 billion in total annual production. So if just this one pension system, in just this one country, moves to their maximum allowed allocation, they'd be buying the equivalent of nearly 10% of global annual mine supply. And India isn't alone. Around the same time, the United States saw regulatory movement on 401 kilobits access to alternative assets, including precious metals, with the Department of Labor reconsidering guidance that had previously discouraged plan sponsors from offering commodity exposure to retirement savers. What you're watching happen is a global regulatory unlock that's been decades in the making. For your entire investing lifetime, pension funds and retirement accounts have been essentially prohibited from meaningful precious metals allocation, not by explicit ban, but by regulatory friction, fiduciary liability concerns, and institutional bias that treated gold and silver as fringe assets for doomsday preppers and gold bugs. That framework is collapsing in real time. Basel III gave precious metals the legitimacy seal. India proved that major regulators are willing to open the gates. The US is following with 401 kilobits rule changes that could eventually give American workers access to silver through their retirement accounts. And once this process starts, it becomes self-reinforcing. Every country that allows pension exposure makes it easier for the next country to justify doing the same. Every major institutional investor that takes a position makes it easier for other institutions to follow without looking radical. This is the legitimacy cascade, and it's just beginning. Now let's talk about what this means in practical terms, because this is where the $200 target stops being a guess and starts being arithmetic. The total global pension fund assets sitting in the world's major retirement systems add up to somewhere between $58 trillion and $70 trillion, depending on which data source you use. Let's be conservative and call it $60 trillion. The vast majority of that money currently sits in traditional 60/40ths portfolios, stocks, and bonds, with maybe a small alternative allocation to real estate or private equity. Precious metals allocation among institutional investors right now is effectively zero, maybe a fraction of a percent for the few forward-thinking funds that got approval to hold gold. So what happens when that starts to change? Let's run some scenarios, and I want you to see how fast the numbers get absurd, given how small the silver market actually is. Scenario 1. Pension funds globally move to a 1% allocation in precious metals, split evenly between gold and silver. That means 0.5% of $60 trillion, or $300 billion, heading toward silver, at current prices around $109. That would represent demand for roughly 2.75 billion ounces. Remember that global mine production is only about 850 million ounces per year, so a 1% institutional allocation, which is tiny by portfolio standards, will require more than 3 years of total global silver production to satisfy, assuming zero demand from anyone else, which obviously isn't realistic. In a market where industrial users, retail investors, and existing ETF holders are also competing for supply, trying to squeeze in an extra 2.75 billion ounces of demand would send prices vertical. That's not speculation, that's just supply and demand math. Scenario 2. Let's say institutions are more conservative and only 10% of the global pension assets, so $6 trillion, decide to add a 2% allocation to silver specifically. That's $120 billion of buying pressure, or about 1.1 billion ounces at current prices. Still more than a full year of global production. Still completely unrealistic to source without massive price appreciation. And here's the thing that makes this even more explosive. This isn't like buying stocks where there's theoretically unlimited supply because companies can issue more shares. This isn't even like buying bonds where governments can print. More silver supply is physically constrained by how fast you can dig it out of the ground. And mine supply has been basically flat for years, while industrial demand keeps growing. So when institutional buyers show up, trying to acquire billions of dollars worth of metal, there's no release valve, no way to create more supply quickly. The only mechanism that can balance supply and demand is price. Prices have to go high enough to either shake loose existing holders or destroy enough industrial demand to free up supply. And given that industrial users need silver for solar panels and electronics and have no good substitutes, demand destruction isn't happening. That means all the adjustment has to come through price. This is why multiple analysts who wouldn't normally make bold calls are suddenly putting $200 to $300 targets on silver for 2026. Robert Kiyosaki has been talking about $200. The DeVere Group put out a forecast calling for $200 by end of year. Bank of America analysts are discussing a range that tops out above $300 in supply shock scenarios. These aren't gold bug bloggers making clickbait predictions. These are firms managing billions of dollars, employing PhD economists, running sophisticated models. And they're all coming to similar conclusions because they're all looking at the same math. When you model out what happens if even a small percentage of institutional capital tries to access a market this size, constrained, the price outcomes get extreme fast. The silver market simply isn't built to absorb this kind of capital inflow at anywhere close to current prices. And here's where the Basel III lesson becomes critical, because it's not just about how much money is coming, it's about how they're going to buy it. Institutional investors are learning from that 2011 crash. Back then, a lot of the silver rally was driven by paper positions, futures contracts, and unallocated ETF shares, where investors thought they owned silver, but really just owned promises. When the crash came, those paper positions got liquidated instantly, margin calls forced selling, and the price collapsed. The smart institutions watched that and concluded that if you're going to own silver, you need to own physical allocated metal that can't be hypothecated, can't be lent out, can't be claimed by multiple parties, and can't vanish in a systemic crisis. And that's exactly what Basel III requires to get the favorable Tier 1 treatment. Paper claims on silver don't count. Unallocated holdings don't count. Only physical allocated metal gets the zero risk. Wait. So the regulatory structure is literally forcing institutions toward the kind of buying that creates permanent supply tightness instead of temporary speculation. Think about what that means in practice. When a pension fund buys allocated physical silver and stores it in their name in a segregated vault, that metal leaves the available supply pool. It's not coming back to market unless silver hits prices high that the fund decides to rebalance and take profits. Contrast that with a paper long position in futures that expires every few months and has to be rolled, or an unallocated ETF share that the fund could sell instantly if markets get choppy. The physical allocated buying that institutions are being steered toward is sticky, permanent, supply-removing buying. Every $1 billion that goes into physical allocated silver is metal that's not available for industrial users, not available for retail buyers, not available to satisfy the next pension fund that decides they want exposure. This creates a ratchet effect where supply gets progressively tighter and prices have to keep rising to clear the market. Now I want to address the elephant in the room, because some of you are thinking about that 2011 crash and wondering if this could end the same way. And the answer is no. And here's why. That rally was driven by retail speculation and leveraged paper positions built on top of a market that still had surplus supply and falling industrial demand. This rally is being driven by institutional capital moving into physical allocated positions in a market that has been in structural deficit for 5 consecutive years and where industrial demand is accelerating, not declining. In 2011, when prices hit $49, silver was expensive relative to fundamentals, and the market structure was fragile. Today at $109, silver is actually underpriced relative to where it needs to go to clear the supply deficit and accommodate the institutional demand that's coming. The downside risk that existed in 2011 was that prices could fall back to marginal cost of production around $20 and still make sense fundamentally. The downside risk today is that prices might pull back from $19 to maybe $90 in a correction. But the structural bid from institutions and industrial users puts a floor under the market that didn't exist 15 years ago. You also need to understand the narrative shift that's happening in real time. For decades, financial advisors and institutional consultants told pension fund boards that precious metals were too volatile, too speculative, not appropriate for fiduciary portfolios responsible for retiree security. That narrative is dying. when Basel III puts silver in the same category as cash and treasuries, when India's pension regulator explicitly approves allocation, when Norway's sovereign wealth fund, the largest and most conservative in the world, starts discussing commodities exposure, the old objections lose their power. Suddenly the risky move isn't buying silver, it's being the pension fund that didn't protect against currency debasement and inflation, while every peer institution was adding hard asset exposure. The professional liability equation flips. In a few years, boards might be asking their investment committees why they didn't have precious metals allocation, and it seemed too risky, won't be an acceptable answer anymore, when half the industry moved that direction and got validated by positive returns. This shift in institutional thinking is why $200 silver starts to look inevitable rather than optimistic. Even if we never get the full 1-2% allocation scenarios I described earlier, even if institutional adoption is slower and smaller than the maximum theoretical impact, you're still talking about tens of billions of dollars trying to access a market with $92 billion in annual supply. And that's before you account for the industrial demand side. Solar panel production alone is projected to consume over 200 million ounces of silver in 2026. Electric vehicles are scaling globally and each one uses 25 to 50 grams of silver. 5G infrastructure, medical applications, water purification, and electronics manufacturing are all growing their silver consumption. Add it all up, and industrial demand is taking something like 60% of annual supply off the market before investors ever get a chance to bid for it. So the portion of production that's actually available for investment buying is maybe 350 million ounces, and you're asking that supply to absorb what could eventually be $100 billion inflows from institutions. The math doesn't work at $109. It probably doesn't work at $150. It might work at $200, or it might take $300, depending on how fast the institutional money moves and whether mine supply can ramp up, which historically takes years. Let me give you a real-world example of how fast these moves can happen when institutional capital makes an allocation decision. In early January, silver ETFs saw net inflows of $5.5 billion in just a matter of trading sessions. That's not accumulated over months. That's within days. And that inflow wasn't even coming from pension funds yet. That was early mover institutional investors and family offices positioning ahead of the regulatory changes they see coming. When pension funds start moving with their quarterly rebalancing, when 401 kilobits platforms add silver options, and millions of American workers can check a box to add precious metals exposure, when sovereign wealth funds update their investment mandates to include commodities, those flows will make $5.5 billion look like a warm-up. We could see weekly inflows that large once this really gets moving. And in a market where visible inventories in exchanges like COMEX are measured in millions of ounces, not billions, that kind of flow creates dislocations that only price can resolve. Now let's talk about what this means for you specifically, because I don't want you to think this is just an academic exercise about what pension funds are doing. If you're an American with a 401 kilobits or IRA, the regulatory changes that are happening right now could fundamentally change your ability to protect your retirement savings with hard assets. The Department of Labor's reconsideration of alternative asset guidance, driven by an executive order that specifically called out the need to reduce barriers to commodities and alternative investments in retirement accounts, means we may be 6 to 12 months away from seeing silver buying options added to major 401 kilobits platforms. When that happens, you'll have the same access to physical-backed silver exposure that until now was only available to wealthy individuals who could set up self-directed IRAs or pay high fees for specialized products. And given that the U.S. retirement system holds over $48 trillion in assets across IRAs, 401ks, and pension plans, even a tiny allocation shift among American savers would represent massive buying pressure. But here's a critical thing you need to understand. The window where regular people can position before the institutional flood hits is closing fast. Silver was at $28 at the start of 2025. It's at $109 now as of late January 2026. That move has already happened. And if you missed it, you missed a nearly 300% return in about a year. However, if the thesis I'm laying out is correct, if we really are at the beginning of a multi-year institutional adoption cycle where trillions of dollars in pension money systematically adds precious metals exposure, then this $109 starting point could look cheap in hindsight when silver is trading at $200 or $250. The difference is that this next leg higher won't be driven by momentum and speculation. Like 2011, it'll be driven by slow, steady, relentless institutional buying that doesn't care about daily price swings and isn't going to panic sell on a 10% dip. This is also why the physical versus paper distinction matters more now than ever. If you're going to position for this institutional wave, you need to be holding the same kind of silver that institutions are buying. That means physical allocated metal, either in your personal possession or in a vault where you have specific serial numbered bars or coins registered to your name. Unallocated pool accounts, where you own a share of a larger pile of metal that the custodian controls, don't give you the same protection. Paper silver, positions and futures of some ETF structures that don't guarantee physical redemption rights, don't give you the same protection. If we reach a point where physical supply gets tight enough that premiums separate from paper prices, which has already started happening in some markets, where physical silver was trading $20 or $30 above spot prices, you want to be on the right side of that divide. You want to be holding the thing that institutions are desperate to acquire, not the thing they're trying to exit. The other reason physical allocated ownership matters is operational. When pension funds buy silver to establish channels, like LBMA-approved vaults or major depositories, they're following strict chain of custody and audit requirements. They're not buying junk silver from random dealers. They're not taking delivery risk on sketchy storage. They're using institutional-grade infrastructure that ensures they actually own what they think they own. As a retail investor, you should be thinking the same way. Buy from recognizable mints like the US Mint, Canadian Mint, or Perth Mint. Buy standardized products like American Eagles, Canadian Maples, or recognize 100-ounce bars. Store them in a way where you can prove ownership, either personal possession in a safe or allocated storage with a reputable vault service that provides regular audits. This isn't the time to be cutting corners or taking risks on product quality or custody arrangements. Because if we get to a point where liquidity is tight and buyers are being selective, the premium products with clear provenance will maintain their value better than generic silver of uncertain origin. Now I want to bring us back to the timeline, because understanding when this institutional wave might hit full force changes how you think about positioning. The regulatory approvals we're seeing now: India in December, US. 401 kilobits guidance changes expected in 2026. These create permission, but not automatic action. Pension funds move slowly. They have investment committees that meet quarterly. They have consultants that need to update recommendations. They have boards that need to approve policy changes. So the allocation shifts I'm describing aren't going to happen overnight. This is a 2026 to 2028 story, maybe extending into 2029, where each quarter you see another handful of pension systems announce they're adding precious metals exposure, where each year the aggregate allocation ticks up from 0.1% to 0.3% to maybe 0.5% by the end of the period. But here's the thing about slow-moving tsunamis. By the time you can see the water rising, it's too late to get to higher ground. The smart money's positioning now. In January 2026, when silver just broke $100, and most people still think this is a commodity trade, that could reverse at any moment. The smart money understands that this is actually an asset. Reclassification, where silver is transitioning from speculative commodity to institutional-grade investment. And that process has historically been a one-way trip. When an asset class gets legitimacy and regulatory approval for institutional ownership, it doesn't lose that status except in extreme circumstances. The real estate investment trust structure that opened institutional real estate to pension funds in the 1960s is still here. The high-yield bond market that became acceptable for institutional portfolios in the 1980s is still here. The emerging markets equity exposure that pension funds started adding in the 1990s is still here. Once institutional capital finds a new home and regulators bless it, that capital tends to stay and accumulate. Silver is having that moment right now in 2026, and the price adjustment to reflect its new status as an institutional asset class instead of a fringe speculation is still in the early innings. So what does $200 silver actually mean in this context? It's not a moonshot prediction or a lottery ticket mentality. It's the price level, where maybe, possibly, the market comes close to balancing institutional demand against constrained supply in a scenario where pension funds hit even modest allocation targets. It's the price where industrial users start to feel real pain and either accept margin compression or search desperately for substitutes that mostly don't exist. It's the price where mine supply might actually start to increase meaningfully, as projects that weren't economic at $20 or $30 become profitable at triple-digit prices, though that takes years to develop. And it's the price where retail investors who bought in the $80 to $110 range might start thinking about taking some profits, creating the selling flow that institutions need to build their positions. At $109, we're not there yet. The market isn't balanced. Supply is still tight. Industrial demand is still growing, and institutional allocation is still essentially zero. All of those facts point to higher prices as the only mechanism that can equilibrate the market. I'll close with this. You're watching a generational shift in how the financial system treats precious metals, and it's happening in slow motion right in front of you. The institutions that swore off silver after the 2011 crash are coming back, older and wiser, with regulatory approval and structural buying that won't create the fragility that led to that crash. The pension funds that have been locked out of this market for decades just got the keys, and they manage more money than the entire silver market is worth by orders of magnitude. The prices we're seeing now, even after silver's massive run, are still based on a world where institutional ownership was functionally zero. We're transitioning to a world where it might be 1% or 2%, or who knows how high, once the legitimacy cascade runs its course. And when an asset class undergoes that kind of transformation, the price adjustments aren't linear, they're not gradual. They don't wait for everyone to get comfortable. They happen in surges as each wave of institutional buyers realizes they need to move before the next wave shows up and drives prices even higher. If you're sitting on the sidelines waiting for a better entry point, I'd ask you this. What's your plan if silver goes to $130 next month because another major pension system announces a new allocation policy? What's your plan if we're sitting here in June and silver is at $160 because US 401 kilobits platforms added it and 10 million American workers decided to put 3% of their retirement savings into it? Are you going to buy then, at prices 50% higher than today, because you finally believe the story? Or are you going to wish you'd taken action when silver was still in the low 100s and the institutional wave was just starting? This isn't about timing the perfect bottom. This is about recognizing a fundamental regime change in market structure and positioning before the full impact hits the people who do that. The people who understand this isn't just another commodity rally, but rather the opening chapter of institutional adoption. Those are the people who will look back in 2 or 3 years and realize they caught one of the most important investment shifts of this decade. Make sure you're subscribed to this channel, because we're going to be tracking every development in the story as it unfolds. Every pension fund announcement, every regulatory change, every price milestone, we'll cover it. Hit that subscribe button, turn on notifications, and drop a comment below telling me if you think $200 silver is optimistic or conservative, given what we've just laid out. Are you already positioned? Are you waiting for confirmation? Or are you still skeptical that institutions will really follow through? I want to hear your perspective, because this community is how we stay ahead of the curve and see these shifts before they become obvious. I'll see you in the next one.